Good morning, everyone. So today's the discussion is about IFRS, that is International Financial Reporting Standard on intangible assets. So the number is IAS 38. So IAS 38 deals with intangible assets. So in a very simple way, if you need to understand what exactly is an intangible asset, so IAS 13 basically defines an intangible asset. Let us see what is this intangible asset. Now, in a simple way, intangible asset is defined as an asset which does not have a physical form. So it's basically something like a fixed asset, but which does not have a physical form. So without physical substance, that is the word that IAS 38 uses. Okay, so basically, if you look at an asset, whether it's a physical asset or a non-physical asset, basically what's an asset? Asset is something which can generate future economic benefit. Something like this: if you purchase a car, that car is going to, serve you for the next 10 years. If you purchase a cell phone, that cell phone is going to serve you for the next 2 to 3 years. So which means it has an economic benefit. It's going to give you some kind of a benefit. For example, if you don't have a car, correct, you'll end up spending a lot of money maybe for on transportation like bus, metro, or Ola, Uber, cab, or something like that. So by having a car in future, you can save money which you are going to spend on Uber or Ola cabs, correct? Which means this is called future economic benefit. In the future, there is going to be a financial benefit, economic benefit, because today you are buying the car. So that's basically what an asset is. Same thing when the asset is no more in physical form, but it is still going to give you future economic benefit. That's basically called an intangible asset. As simple as that. It's kind of fixed assets, but there's nothing to be fixed to because they do not have a physical substance. That's the reason why we call them intangible assets. Classic example is copyright. Okay, suppose I'm a music director, I have composed a music. Okay, music does not have a physical substance, correct? But since I have composed a music, maybe I may be able to sell it, or maybe I may be able to rent out my music, or sell the rights of my music, rent out or lease out the rights of my music. So in a way, that music, even though it's a non-physical asset, no physical substance, still it is able to generate some economic benefit for me. So as simple as that. So intangible assets are assets which do not have a physical substance but still are capable of generating future economic benefit. Got the logic? Now, when should we recognize an intangible asset in the books of a company? Suppose we are a business, right? Should we recognize an intangible asset? See, basically, balance sheet has assets and liabilities. What do you mean by recognize? Recognize in the balance sheet basically means it has to appear in the asset side of the balance sheet. So when should we make an intangible asset appear? This is called recognition criteria. When to recognize an asset in the balance sheet. Now let us look at two cases. One is, did you buy the intangible asset from somewhere, or did you generate it by yourself? It's like something like, did you make the food yourself or did you order it from Swiggy? Simple, na? If you make the food at home, that would be called self-generated. If you purchase the food from Swiggy, that is basically purchased. Same way, intangible asset can be self-generated. I made it myself. So I basically invented a formula. I basically invented a recipe. I invented music. This could be the case. That is self-generated intangible assets. The other side of the story is, no, it's not self-generated. Someone has invented. I just purchased that invention. Someone has invented a formula. I just purchased the formula, something like that, correct? So both cases. So let us look at both cases separately. First, let us look at purchased. Okay, I have purchased it, correct? Or forget it, whether you purchased it or whether you self-generated it. Let us look at some recognition basic criteria first. See, one is, when should we recognize? Okay, two cases of when we can recognize. First case when we can recognize is, it has to be separable. What do you mean by separable? Understand this. It's a separate asset. Like, I go and purchase formula from Coke. Coke has a formula, right? Coca-Cola has a flavor, correct? Someone has invented that flavor. Obviously, we don't know how to make that flavor. If we know how to make that flavor, we can prepare Coke at our home on a daily basis, correct? So obviously Coke's taste cannot be replicated at home, and that's because you do not know the formula. So one way is go to Coca-Cola India and buy off the formula. This is one way. Second way is, why don't we just buy off the whole Coca-Cola company itself? Along with that, formula also will come, right? Because Coca-Cola company owns factories, owns production facilities. Why just the formula? Why don't we just buy off the whole Coca-Cola company? Correct, both ways. But if you look at this, suppose I go and purchase Coca-Cola formula, that's a separate asset. But if I buy the whole company, correct, so as a part of the company you got Coca-Cola as an asset, correct na? So can we still separate it? Yeah, you can still say, yeah, the company, I bought it for, let's say, $100 billion or whatever. Out of that, the formula costs $1 billion. It's still separable, correct? What do you mean by separable? It's something like this. Suppose I am there, okay? So I am there and my reputation is there. Is I and my reputation two separate things? Can I sell my reputation? Correct? Can I sell my reputation? Suppose I get paid because I go and lecture at places. Correct? So my reputation is a part of me. Can I sell my reputation separately without selling myself? That's called separability. So that's where it becomes a challenge. How do you sell your reputation without selling yourself? Correct? So this is called separability. Correct? So if separability is not there, IAS 38 says that you cannot recognize the intangible asset. So you can recognize the intangible asset when you can separate it. Separate it from what? Separate it from some other asset. So if an intangible asset, it is hidden inside another asset and unable to separate it from that asset, this is where the problem comes in recognition, and IAS 38 says please don't recognize such assets. Okay, so one example was I gave that I and my reputation is not the same thing, correct? Let us look at another aspect of it from a very practical perspective. Okay, let us look at the book. Okay, there is a book with you. Okay, now you can sell the book. Okay, you have written a book. Let's say you have struggled for 6 months, 10 months. Every day you have spent 3-4 hours and you have actually written a book. You can sell the book to someone. Or why do I sell the book? Don't sell the book, sell the content of the book to someone so that they can print that content on thousands of copies and sell. Maybe you can charge a royalty for every copy that is sold. So in a way, you need not sell the book. The book and the content of the book are separable. Got the logic? Which means book is maybe an asset, but the content of the book can be sold separately, which means it is separable. So IAS 38 says that please recognize it in the balance sheet as an asset only if this separability exists. Now this is one case. Second case is, it's not always about separable. Also we are looking at contractual rights. Okay, it's not about separability or not separability. The question is, is there an asset arising out of a contractual right? Correct? Is there an asset arising out of a contractual right? Which means I have a copyright music, only I can use it, no one else can use it, which means you have a contract, you have a right. Correct? Can I sell that right to someone? Yeah, maybe you can sell the right to someone. Correct? Can I transfer the right to someone? Yeah, maybe. So there are two aspects which we are looking at. So the first aspect is separability and the second aspect is your legal rights. Correct? If any of these two things exist, then we say the intangible asset is identifiable. Since it is identifiable, please go and book it in the balance sheet and show it on the asset side. Cool. Now question is, sir, how long the asset keeps appearing? Does that intangible asset appear every year in the balance sheet? That depends on the useful life of the asset. What do you mean by useful life of the asset? We've already seen, if I buy a car, the car is going to give me benefit for 10 years, then that 10 years is the useful life. If I buy a formula, that formula is going to work for me for 5 years, then 5 years is the useful life. You might ask me, sir, why is the formula not working after 5 years? It might work for infinite years, right? Yeah, possible. But then maybe after 5 years, someone else comes up with a better formula and no one is interested in your formula. So that is where you need to look at useful life. Correct? So sometimes it's on the useful life. Sometimes it could be on a number of units of production. For example, I go to Coca-Cola. I tell them that you please give me your formula. I'll use it for 1 year and give it back to you. So for the next 1 year, I can manufacture Coke using that formula. How many ever bottles? So in this case, useful life becomes 1 year closed. Think about a second case. Coke gives me their formula and tells me that, dude, I'm giving you the formula, but you can use the formula only for 1 lakh Coke bottles. Okay, after you have manufactured 1 lakh Coke bottles, you have to return the formula to me. So now 1 lakh Coke bottles can be manufactured in a single day, or over 1 year, or over 10 years. No, now the useful life of the asset is no more in terms of years, it's in terms of number of bottles. Correct? So until when should the intangible asset keep coming in the balance sheet? Until the useful life gets over, and the useful life need not necessarily be measured in terms of years. Sometimes it's measured even in terms of units. Now, just like any other fixed asset we depreciate, intangible asset also we depreciate, but since it's intangible, we don't call it depreciation, we call it amortization. So we basically amortize intangible assets. It's basically nothing but depreciation. Yeah, got the logic? Now, uh, when should we recognize it? Recognition criteria. That when the first time in my life, until now the balance sheet does not have anything called an intangible asset. Now for the first time I want to put an intangible asset. Anything we are doing for the first time is called initial measurement. Correct? First time when I am putting how much should be the value of that. Correct? There are two criteria for this according to IAS 38. The first criteria is how much is the future economic benefit. Correct? What is the future economic benefit? Correct? And can we identify how much future economic benefits this asset is creating? Correct? And we measure it, the cost. Okay, to acquire a particular intangible asset, what is the cost? As I told you, now the discussion starts off is it a self-generated asset or a bought off asset? No, I just purchased a Coke formula from Coca-Cola. Oh great, then it is very easy. What did you pay to purchase that? That is the cost of the intangible asset. Please show that in your balance sheet. Finished. No, I have invented the Coke formula. Okay, great. What is the cost of inventing the Coke formula? Put that cost into your balance sheet. Simple way. Correct? Now, suppose case 1, sir, I purchased something from Coke. All expenses for purchasing it, everything, add it, unless they are refundable. For example, there are certain taxes like GST where we get a tax credit. Okay, leave those things. Sir, I bought the formula, great. Okay, so they sent me the formula in the form of a email. Okay, so getting an email, there is zero cost. Great. So they asked me to pay so and so money. Okay, I paid $1 billion. Okay, then I had to register the formula in my name because it was already in Coke's name earlier. So the registration charge cost came to around another, let's say, $0.1 billion. So already $1 billion plus 0.1, we are at $1.1 billion. So keep adding all the costs, whatever you have incurred to purchase that, and all the costs except the refundable costs like tax credits, and if they are giving a discount, obviously discount it, right? So that's how it is. Now also, so no sir, no, I have developed it myself. Now this is where the real trick comes. You have developed the intangible asset by yourself, right? If that is the case, then we need to so what's the cost? What's the cost of developing the asset? So all the cost of self-generating an intangible asset can be looked at from two angles: the research phase and the development phase. This is the most important concept of IAS 38 basically, because when we purchase of formulas from people, it's so damn easy. This is what I paid, and these are the other expenses, other attributable expenses. Correct? And totally this is what is the cost. Question is, what if I made the formula by myself? This is where, so how much cost did you spend? So sometimes it's difficult to measure, because what if it's a fluke invention, we were just doing something and something came up. Okay. Most of the research and development, I would not say fluke, but you never know the outcome, right? When a scientist starts a research, he never knows finally at the end of the research what product is he going to invent. A classic example is there is this American company called 3M which invents a lot of products. So 3M wanted to invent the world's most powerful adhesive, that's a gum, a resin which can stick two things together. And after a lot of research, they finally ended up with actually inventing the world's most temporary adhesive which sticks only for a while, but they could commercialize it. That's what is called the post-it notes. The post-it notes which we stick on a refrigerator, on any metal surface, or in your workstations and offices, right? So those are like, so inventions you never know. You keep doing the research, you don't know the outcome. That's the reason IAS 38 bifurcates all the expenses of self-generated intangible asset into research phase and development phase. Now, what is the research phase? The research phase is simple. Research phase is basically all the effort which you are doing without knowing what product is going to come in the end. Once you get an idea that, oh, this is the product, then after that whatever expense you do is the development phase. So basically development phase is go to market phase. So we have invented something, how to commercialize this invention is the development phase. So a classic example of what falls under research phase and what falls under your development phase, what expenses fall under research phase. So research phase basically the expenditure on research, correct? That is the initial expenditure when you are still experimenting, buying raw materials or buying some chemicals or buying something, trying to experiment, all that is research phase. Okay, so IAS 38 gives you a simple treatment. Whatever expenses you have done on the research phase, you need to put them into your profit and loss account and not the balance sheet, which means expense them off. Okay, those cannot go into the balance sheet as a cost of your intangible assets. Simple. Why? Because no research guarantees an invention, correct? When you don't even know what you are going to invent, which means research is a continuous, ongoing, indefinite process. We may be conducting research for the next 100 years and still not invent anything. That's how research is, correct? You have to be patient. So just because you have invented after 100 years of research doesn't mean last 100 years all my food, bed, every expense I am going to put it in the balance sheet as the cost of the asset. No. That's why all the research phase of expenses is expensed off in the P&L account. Now what is capitalized, that is what becomes the cost of the intangible asset. What is capitalized is the development phase of expenses. Now what exactly is the development phase of expenses? Let me give you a brief examples. One is technical feasibility, which means I put 5 years of research and finally a product has arrived. Great, excellent. So up to this whatever expenses, please put it in the P&L as research. Product is ready in your hand, but just one piece, right? How to sell this, how many pieces to make, where to make on a commercial scale, how to advertise this, how to penetrate, correct? How to find out whether this invention is even required by people in the market. From here on, every other expense is basically your development expense, like technical feasibility. Like, is it technically feasible to go large scale production? Correct. Similarly, how to sell this asset, planning, so all those expenses of deciding how to sell, correct. Similarly, how much money is it going to generate in future if we sell? For that we are again employing people, so all those people's cost, correct. Are there available or resources? Like right now, since 5 years we have just made one product. If we want to make 1,000 or 10,000 such products, do we have enough raw material? We have to study all these things, and this studying needs people, and those people need salaries, correct. All these expenses are called development expenses because the product is already ready. So in a simple way, everything that comes up to research phase is your this thing, revenue, that is put it in the P&L. Once product is ready, everything is your development phase until you hit the market commercially. All those expenses are basically your development phase, and development phase is capitalized, meaning that is the past of the cost of the intangible asset. Great. Now the next thing comes is, okay, great, now initial recognition is over, we have the intangible asset sitting in our balance sheet. Now what? Correct. Initial asset is ready and we have it sitting in our balance sheet. Now please keep looking at it every year. Why do we have to look at it every year? Now two things: either you have to amortize it because the value is going down. How to amortize? Over the useful life of the period. As we told, the useful life could be in terms of years, could be in terms of number of units. Whatever is the most appropriate way of amortizing, please amortize. For example, now it's just valid for 5 years. Okay, on a straight line method basis, if the total value of intangible asset is 5 million, every year amortize 1 million, finish it. No, it's on the basis of number of units. Okay, great. In that case, Coca-Cola gave you license for 1 lakh units, right? Yeah, out of 1 lakh units in the first year, I made 60,000 units, and the second year I made 40,000 units. Okay, the total 1 million expense, now please write it off in 6:4 ratio. That is 60, whatever, 0.6 million is to 4, 0.4, 60,000 is to 40,000, depending on the number of units. So you can choose any way of amortization, but if you're not able to choose any way, stick to straight line method. Every year the same amount you can amortize, you can stick to that. So every year keep checking at realistically, is the intangible asset still valid? Because sometimes your invention you thought is amazing, next year people are thinking this is a stupid invention and no one is buying it. For example, before cell phones there was a phase where there was an invention called a pager. A pager was a small machine which men used to usually hang it to their belts, and women sometimes used to wear it as a tag. It's basically this much of a device with a small screen, and someone can send you a message, you can't even send a message back out. So it just, I mean, this was pre-cell phone era. Today no one bloody uses it, is it not? So there are certain inventions which are great for a while, but you thought, okay, pager is the next groundbreaking invention, in the next 20 years will mint money, but in 2 years you fizzled out because the next big invention called cell phone has come out. So yeah, so every year you need to look at, is your intangible asset still has an economic benefit? Otherwise keep amortizing, as simple as it, write it off. This concept is called impairment. Impairment means the asset is losing a lot of value suddenly. Write it off, depreciate it, amortize it, and close it. Correct? So every year we need to re-look at all these things. Getting the logic? Now also when it comes to IAS 38, so as we saw, annually keep taking a stock whether those figures are still valid. Also annually please keep looking at, is the useful life of the asset still exists, I mean, is it still useful? Correct? So pretty much this is what is IAS 38. Now what are the other nitty-gritties in this is pretty much that's the concept. Pretty much that's the concept. So it's a very easy concept if you see. There's nothing greatly complicated in it. So in a very very simple way, if we have to put it out, we can say that uh, intangible asset can either be purchased or be self-generated, right? If you are purchasing it, whatever cost of purchase, including directly attributable other costs also, please pull it up together, and that would be the cost of your intangible asset. Obviously please eliminate refundable expenses, refundable costs. Then what about the self-generated? Now we know self-generated assets have a research phase and a development phase. Research phase is up to the product comes, so up to then please expense it off in the P&L. Once the product is ready, all expenses to commercialize it, like test run, a pilot run, a technical feasibility, correct, maybe an inspection, okay, or market study to make it commercial, study of availability of raw materials, supply chains, go study of distribution networks, of how this product reaches the customers, correct. All these things, all these expenses would be called development expenses. That is the cost of the intangible asset, not the research phase. And every year we need to keep looking at the useful life of the asset, is it still relevant? Also every year we need to keep looking at the does it still have future economic benefit? Okay, does it, I mean, is it still there? And the useful life of the asset, every year keep looking at it. If we need any adjustment in that, that's what you pretty much need to do. In fact, IAS 38 doesn't even tell you which method to use. You can use any reasonable method to amortize, but if you are not able to figure out, then just stick to your SLM, straight line method. Now let us look at few specific cases of what IAS talks about. Okay, IAS, what does it talk about for a few specific cases? Okay, so what it says is, suppose I have purchased off a whole business and not just one formula. I purchased off the whole business, along with it the formula came. So now in that case, how much to show the formula, at what value of the formula to be shown in the balance sheet? Fair value. Whatever is the fair value, fair value is the rough market value of the asset. So show it at the fair value, as simple as that. Correct. So do that. But again, it has to be separable. As we said, the first criteria is identifiability of the asset, and identifiability of the asset comes because of separability. It should be separately sold, the book and the content, the example which I have given. So separability has to be there, correct, and there has to be a future economic benefit also, correct. And so that's when we actually do it. So that is one example. Another example which gives is, no, I didn't buy it for money, I took a formula, instead I gave my car. Okay, then the value of the intangible asset is the fair value of the car. Simple, right? So if that car has a fair value in the market, whatever is the fair value of the car in the market, that's the value. This is exchange of assets case. Now another thing could be government grant. Government grant is, government just gave me a formula. Okay, government granted me a formula. Again, same drama. That is, fair value. Okay, what's the fair value of that invention or the formula? Recognize it at fair value. Okay, no, government granted the formula, but they asked me to pay also. Okay, then even then we are going to book it at fair value. What else? Correct. Next, internally generated goodwill. Sir, is goodwill an intangible asset? Correct, because I have worked hard and built a reputation. That reputation, is also an asset, right? How much should I show it at balance sheet? IAS 38 says, please do not show it. Internally generated goodwill is never shown in the balance sheet. Then what goodwill is shown? When you purchase a business and along with it you purchase their reputation, that's when when goodwill purchased is recognized according in the balance sheet. But a goodwill which you have self-generated doesn't get recognized under IAS 38. Got the logic? So that's pretty much what is your IAS 38. So I hope you've got a decent idea. Obviously there are disclosure standards. Disclosure standards are pretty much the same for most of the IFRS, especially when it comes to these kind of items. Opening balances of your intangible assets, additions, disposals, that is minus whatever you have gotten rid of, minus amortizations, that is yearly depreciations, minus impairments, if you have impaired something, remove that, plus reversal of impairment, if you first thought the value has gone down, so impaired, but later the value of the formula went up. So finally you get to the closing balance, disclose all these things separately for each intangible asset. Disclose the useful life of the asset, disclose the probable economic benefit of the asset. That's pretty much what is IAS 38. I mean, there's no rocket science in this. It's a pretty easy accounting standard. I mean, it's a reporting standard. Okay, so I hope this gives you a decent idea of what exactly we're talking about. So thank you. I am CA Chartered Accountant Vijay Krishna Dharani. Hope this was helpful. Thanks.